Thanks for listening to A Long Time in Finance with Jonathan Ford and Neil Collins, in partnership with Briefcase.News, the service that brings intelligent curation and analysis to your media monitoring.
So, today we are lucky enough to have snared Jim Leaviss, who anybody who knows anything about the bond market will know the name has been a giant of the bond market for many years, since 1992, which even by my standards is quite a long time ago, although not exactly the whole of my rather long career. Anyway, we are very pleased to have you here, and Jim is a pioneer in analysing and writing about the bond markets, the UK gilt markets essentially, and actually trying to persuade the rest of us that they're nothing like as dull as most of us thought they were, certainly back in 1992. Jim, welcome.
Hello.
He is now about to hang up his boots at M&G and go and study fine art instead.
Hang up my bond calculator. Yeah.
One of those Hewlett-Packard
things
with the incomprehensible buttons.
Yes.
Well, I remember when they used to do the sums almost by hand in the to
and
try
write them down on a slate.
Yes.
Yeah.
They did. They had slide rules and primitive calculators. Anyway, I don't want to get into this sort of detail. Jim, what is it that first attracted you to this rather esoteric and unknown market?
Well, the bonds find you, Neil. At the end, I had no idea about financial markets when I was a student. I think I applied for 3 jobs on the milk round, as it was known at university, one of which was W.H. Smith, which was where I had a Saturday job, but they didn't want me. The other was the civil service graduate scheme, but the Bank of England offered me a job first.
So a lucky escape,
escape from W.H. Smith, although, you could, as many sweets as you could eat at lunchtime. So I ended up at the Bank of England, and my first role there was in the statistics area, calculating, for those of you who remember when people cared about monetary aggregates, things like M0 and M4, and this was the days when the money supply was important, but also leading on from that, the public sector borrowing requirement in the days when people cared about how much the government borrowed. Yeah. And that led on to moving to the gilt area, which at the time was run by Paul Tucker, who became Deputy Governor of the Bank of England. So it was a great place to learn.
But you started, I think, in September 1992?
Yeah.
Which was a bit of a landmark period for the Bank of England. You must have arrived to find some rather long faces after Black Wednesday.
Yeah, long faces all round, because obviously the day before, sterling had been kicked out of the exchange rate mechanism. Interest rates, they never quite got to 15%, but it was announced that they were going up from 12 to 15, but the pound was pulled out of the mechanism before that came into effect. By the time I joined the next day and the bank was mopping up the damage, we're out of the exchange rate mechanism and interest rates were back down to 10, but 10% base rate. There were long faces. I remember just talking to people in, who were around about the bank at the time, who had all taken out mortgages on the worst flats you can imagine at the time for them, with huge multiples of their salary, and they were just in despair that they would ever be able to keep paying their mortgages or move house.
Mm-hmm. How wrong they were.
Exactly.
Since Black Wednesday was the day that turned the British economy into a growth business for the next couple of decades. So how long were you there?
I was there for just 5 years, so I spent a couple of years doing monetary statistics, and then I moved down to the dealing room to work with someone called Hamish Watson, who was the head of the gilt dealing desk.
And then?
Well, then I met somebody called Theo Zemek at a party, and she offered me a job being a gilt fund manager, and that was in 1997. So, and lucky enough, and I give her lots of credit, not only for my career, but also for the development of the bond market in the UK. But she launched the very first corporate bond fund in the UK, the very first high yield bond fund in the UK, I think she made investing in bonds interesting for people. So she would do these great presentations where she'd bring history and literature and all of those things in.
Excellent.
And, I love that.
So having seen that the bond market was not as dull as some of us thought it was, then what happened?
Well, what happened then was an incredible stroke of luck in that China entered the global economy, particularly joining the World Trade Organization a few years later, but already growing in influence in terms of Asia pumping out cheap stuff to the rest of the world at the same time as the internet was invented, and we all found that we could buy the cheapest things in the world by searching for them rather than going to the shop round the corner. So profit margins obviously, take a bit of a hit there, but prices come down around the world. And demographics also were a stroke of luck in that the baby boomers were at their peak earning capacity, thinking about their retirement and all wanting bonds. So you had this perfect storm for bond markets for pretty much my entire career, which is low inflation, helped a bit by independent central banks. They obviously took all the credit for low inflation, but really it was a globalization of the goods market, the labour market, freedom of movement, the EU, widening and deepening, and at the same time technology bringing down prices. So a fantastic time. 1994 10-year US Treasury bond yields were up at 8%, and throughout my career really they were falling all the way down to pretty much zero in 2020 during COVID.
Would you say that the most important thing that happened in your career in the world?
Yeah, I think globalization. So, if you want to think about threats to interest rate and threats to inflation in the next 30 years, deglobalization is going to be one of those big threats to reverse this benign, very stable inflation world that we've been in. Stable growth, stable inflation, stable geopolitics. And, 1992, I think, the year I joined markets, was also the year that Francis Fukuyama wrote his book, The End of History, in which there was this incredible optimism that the Berlin Wall had come down, the Soviet Union was turning into a capitalist world, and that we had globalization, that democracy was where everyone was aiming for, that liberalization. And it feels at the moment that a lot of those trends that we've talked about just now and that end of history hypothesis are under threat, not least Donald Trump and so forth.
But it wasn't that stable. I mean, you had wars in the Middle East, you had financial crisis of 2008, you had the Euro crisis. It was sort of almost from the very beginning, it shook itself to pieces.
But the thing that underlay it was essentially a 30-year bull market in fixed interest stocks everywhere, as interest rates just continued to fall. I can remember when they were 15%, which was slightly before you started, but really it was an extraordinary time. And just tell us what you achieved at M&G in terms of encouraging people to enter this market in terms of assets under management, because I think that people have really little understanding of just how big this market is and how big M&G's position became.
Yeah, well, you open your financial pages of the paper, it'll be full of stories about companies and what the stock market did yesterday and so on. But people involved in markets know that bond markets dwarf the size of equity markets and also drive the price of equities. If you think about the long-term US Treasury bond yield is the most important price in the world. It effectively sets the price of all other assets. When bond yields go up, it makes the dividends on your equity look less attractive relatively, and you end up with falling equity prices. So what happens in bond markets determines what goes on everywhere, whether it's property, whether it's equities or any other asset class. I think that what M&G realised as well at the same time was that corporate bond markets were going to be big and important too. And they were, again, when I started, you would find out about bond prices by Greenwells, which was HSBC, or Warburg's, which is now UBS, would send out brightly coloured pieces of paper with lists of prices on every day, and you'd get those in your internal mail as a fund manager. Bloomberg had been invented as well at this time, but that persisted for a while. And when it came to corporate bonds, there would be one sheet and it would be what we call bulldogs or supranationals. So
what are bulldogs?
Well, they'd just be what they would call UK corporate bonds in the day, where bulldog was a representation of the UK market. There wouldn't be very many in the UK. It'd be a couple of utilities, a couple of banks, and the rest would be supranationals like the European Investment Bank and so on. But M&G realised that market was going to grow, so launched this corporate bond fund against a lot of internal resistance. What are these things? Surely they'll go bust, especially when it came to high yield. It took a while to build that culture of investing in corporate bonds, but also helped by Nigel Lawson, who allowed them to go into the PEPs, which were, a tax-free savings
These
vehicle.
are the first iteration of what then became the ISA.
Exactly. So that they became very, very popular at the time. So corporate bond market grew and grew and grew. And as a result of that, we moved from being 4 people in a corner of Minster Court, which was this building that was used as Cruella de Vil's headquarters in the 101 Dalmatians film. Yeah, very curious, some gothic thing overlooking the Thames. We were in there, 4 of us in the corner, and we were acquired by Prudential a couple of years later, but we'd already started to build up a big book of credit business. Prudential also had its life fund, which at the time had independently realised that if you were a corporate bond investor and you had a long-term time horizon, the spread that you got over and above a gilt or a US Treasury was always higher than the losses that you would suffer from defaults. And if you were on top of that were able to invest in a credit team, then you'd avoid even more of those defaults.
How big is the fund or the combined funds now at M&G?
It's about £140 billion sterling.
140 billion,
Yeah.
yes. So you, at some stage, started this, I don't know what to call it really, a thing called Bond Vigilantes.
A blog.
It started as
A blog.
Did it start as a blog?
It started as a blog when blogs were a thing back in the day, 16 or 17 years ago, partly at a time when equities had come back into fashion briefly and bonds weren't getting as much attention, in the press and amongst clients and salespeople. We wanted to say, actually, there's lots of interesting things going on here.
This was the financial crisis then?
No, before the financial crisis.
Before.
So it's about, I think, 2006 or something like that.
Okay,
so
just before.
Yeah, when things were going well for equity markets, and we thought there's lots going on in bond markets, including, I'm not saying we should have been in the film The Big Short instead of Michael Berry or whatever his name was. Yeah, but if you do look back at the Bond Vigilantes blog at the time, we were writing about those same stresses, and we were positioned for banks and property and ABS type instruments to get into difficulty. So we were telling clients, this is where we see the stresses in the system, particularly the US housing market at the moment.
So you had your posse would have been dashing around in all directions within a year or so of launch.
Yeah, definitely. It was a very exciting, scary time. Pride in having called it. It doesn't immunise you from the feeling that, oh my God, am I going to be living up in the hills eating beans with a spoon whilst society crumbles because
shotgun in your lap.
Yeah, shotgun in my lap, or Nerf gun is actually what my kids have got.
Well, I thought Bond Vigilantes was a great name.
Yeah, I was always a bit nervous about it. I mean, it is a great name. It's a great brand name, but it also has connotations of evil and investors holding democratically elected governments hostage. But it is a great name, isn't it?
I do remember reading, as every journalist is desperately short of something to write about, I fell gratefully on it time after time, thinking, with a name like that, it's got to have something outrageous to say. And sometimes it did, and sometimes it just said, oh, everything's sort of not too bad at the moment. You think, oh, okay.
Sorry about that.
Not very vigilante.
Well, hopefully that shows that we weren't just sensationalists. We were
not like the media.
Pragmatic. Yes.
So one of the themes that we have had to endure over the last, I suppose, 30 years, particularly in the last decade or so, is incontinent governments incapable of raising as much revenue as they are spending to meet their commitments and wishes and ambitions. Has that changed the nature of the bond markets in the last few years, or are you going to tell me 'twas ever thus?
I mean, there is a bit of that. At the Bank of England in 1994, I can't remember how many gilts we had to issue, but there was this feeling that it was too many for the market to cope with, and it was a trivial amount by today's standards. And we've seen that every crisis that we've been through, the response now from governments is more fiscal stimulus, response from central banks is lower interest rates. And I do worry a bit that we've moved into a world where bad things are simply not allowed to happen anymore. And maybe that's not good for long-term growth. You don't get creative destruction if every time there's a short slowdown in economic growth, that you end up with interest rates being cut or fiscal stimulus. As you rightly say, I don't think austerity under Cameron and since had been a good idea. It was at the wrong time, in the wrong places, and did damage to the economy. But at the moment, governments don't appear to be allowed to do anything other than extreme fiscal expansion. And if you look at France, for instance, the elections we've just had, whether it was going to be the left or the right, both of them would result in significant increases in France's deficit, which is already high and already on the kind of warning lists for the credit rating agencies to downgrade. So populism seems to lead to more spending. That's the idea of populism, bread and circuses and all of those sorts of things. And while we're in a populist world, I think that we're going to see there are already some structural headwinds that would cause debt to go up and up around ageing populations. But if you throw on top of that populism and the need to keep everyone happy all the time, it perhaps is a more dangerous place. History tells you can run big budget deficits and big debt to GDP levels. Japan at the moment, the UK and the US after World War II. So there are those that say, if you can print your own currency and you're in good standing, then you've got nothing to worry about. I think, though, Trussonomics was a bit of a wake-up call. What caused the gilt market to sell off on Trussonomics? Was it, A, the amount of new gilts we were going to get? Was it about fears about fiscal incompetence to some extent, or not fiscal incompetence, but fiscal largesse? Was it about
fiscal incontinence?
However you want to describe it.
But there was also a technical reason people...
the LDI stuff.
The pension funds.
But that's exacerbated it, so that's definitely a factor. Secondly, was it about how that spending was going to take place? Or was it, 3, about a threat to the institutions of state, disrespecting the Bank of England, disrespecting the Office of Budget Responsibility, suggesting that what are you buying when you buy a bond? You're buying a promise to have your legal rights respected. And if you have governments, and I'll include here in the threat in the US of a Trump government and what we've seen around the rule of law there, bond markets really do care about promises, about safeguards, proper institutions that protect your investment, that will be there whoever's in power. And I think that maybe the Trussonomics incident was a combination of those 3 things.
Going back a bit, one thing that has always puzzled me, and particularly when long gilt yields were little more than 1%, why were the long-term institutions buying these things when short rates were much the same? The only justification I can see is that they had a sort of rather sad belief that the yields were going to go down even further, because it seemed to me that the opportunity cost of essentially leaving your money in the bank rather than lending it out for 20 years at 1% was trivial, and the downside risk was very substantial, as indeed it has now proved. And I don't understand why so many of these long-term institutions were buying these bonds.
I'm going to make a guess here that you probably thought that 6%, 5%, 4%, 3% and 2% long-dated bond yields were way too low to be attractive at the time.
Well, 6 and possibly 5. But yes, certainly less than that, I would say, why?
Yeah, I think that one thing we look at in bond world is real yields rather than nominal yields. So you look at inflation adjusted yields. When inflation is incredibly low, as it was falling even before COVID hit, remember, it was below target. So if you're talking about 1.5%, then a gilt yield with 1.5% inflation in nominal terms looks way more attractive than perhaps it did in the 1980s when you had a 7% or 8% long-dated gilt yield, but inflation was 8% or 9%. So, real yield is more important. The other thing to note is, of course, that long-term investors, like hedge funds, they're not really punting on direction of bond markets in many cases. They're immunising or matching their liabilities. The pension that they have to pay in a certain number of years' time, they are buying the income stream that matches that. And that's true of annuities or life companies, defined benefit pension schemes. So there were some price insensitive buyers out there.
Apart from the Bank of England, of course, which was doing it for a totally different reason.
Another very price insensitive buyer.
But just on that, I mean, liability matching that you've just talked about, which is where pension funds were essentially buying bonds not because they thought they were a good deal in themselves, but because they mirrored the liabilities they had to pay pensions. Setting aside whether it made sense for them, some people think it's been pretty much a disaster for the economy in the sense that it's removed a huge amount of what was essentially risk capital going into backing businesses doing stuff and replaced it with a great wad of long-term debt.
Yeah. On the other hand, if you ask people on the street, what would you prefer? A defined benefit pension that pays you some guarantee of your final salary? Or we know that a lot of people invest in defined contribution pensions, sit in cash, or they'll buy equities at the wrong time, or they'll buy Tesla shares rather than a diversified bucket. And so I do worry a bit that defined contribution pensions produce, some outcomes and risks that are also undesirable. But I do get the idea that investment in equities has been lower than it would have been otherwise because
you've been too successful. That's my point.
Well, I mean, if you truly believe this, then the good news is that there are no new defined benefit pension schemes. Yeah. Most of them are mature now. Yeah. Most of them are fully funded and have moved into a new buyout regime. They've become annuities. So it is a market that's going away. So you may have your wish, and everyone will be playing roulette in the defined contribution market. Excellent. And some people will buy the right thing and some people won't.
Yes, I know that people are risk averse because they don't really understand what risk is about.
Yes.
They confuse risk with volatility. If you were not going to do something more interesting, what are your thoughts?
You can't say that, Neil. This is a podcast about finance. You can't say art history is more interesting than what we're talking about. Otherwise, we'll have to become an art history podcast.
So where do you think we are in terms of the usual problems, as we've discussed before, of state incontinence, ageing population, deteriorating finance, very low growth, and geopolitical instability? If you were still writing at Bond Vigilantes looking forward, what is your thought at the moment?
I think that in the shorter term, things are moving in the right direction for bond investors. So we've seen recently that US inflation is finally coming down. Remember, when we started 2024, the inflation numbers were overshooting and disappointing, and people dramatically scaled back their expectations for what the Fed was going to do in terms of rate cuts. But finally, everything's going in the right direction, including some things that are going in the wrong direction but should also cause the Fed to cut, i.e. the US labour market is cooling down. In a soft way, in a nice way, but history does tell you that once unemployment rates start rising, there is a period where it looks quite benign, but it generally does deteriorate cyclically quite suddenly. people involved in hiring decisions look around, stop hiring dead, and then the layoffs start. So it feels like the Fed will be cutting interest rates and the Bank of England will be cutting interest rates. The ECB's already started cutting, Swiss National Bank. So we're in a rate cutting cycle, just the Fed hasn't quite started yet. And that will be positive for bond investors going forwards. In a backdrop, though, that the geopolitics is going to be problematic still. The US election, does that increase the risks of a US Trussonomics style event if Donald Trump announces a shock, massive tax cut? I mean, a tax cut's already partly in the price of a Trump victory, but could it be even bigger than that, more dramatic? Could the tariffs be more aggressive? Would that cause higher inflation rates at the same time as higher borrowing? And does he attack? We talked about the institutions of the state. Is Powell's job as Fed chair safe? Is there some arm twisting? Interest rates are too high. I'm going to tell you to cut interest rates, or I'm going to move the Fed into the White House and I'm going to be doing it. I think you've got to at least think about some of these outliers that could be bond negative.
You make it sound as though we're just a cork in the UK bobbing around on the sea that is the United States. Is that a fair summary?
Yeah, it's a definite fair summary, and we'll deviate every now and then, but the global interest rate is set by the United States.
Before we let Jim go, I want to do something which we haven't done before, which is to do quick fire questions at you.
Oh,
can I do that?
Yeah, of course you can.
Yeah,
right.
Go for it.
Favourite fiscal rule?
Am I allowed not to have a favourite fiscal
do
rule?
what you like.
I'm gonna say Gordon Brown's golden rule.
Golden rule.
I can't remember what it was, but it's got the only name I can remember.
Is that the thing which Prudence thought up?
Yeah.
Okay. Favourite indicator?
How about this one? The Baltic Dry Freight Index.
Oh, I love it.
Oh,
I absolutely love it. I
yes.
once wrote an article about the Baltic Freight.
The Baltic Dry.
Whenever
Dry.
we used to write about it, you'd get a host of people saying, "Actually, it's this someone's built a new ship, and that's why the numbers gone up and down." Blah,
One
blah.
ship moved the numbers.
Yeah,
Bloody
I
hell.
don't know, but it did used to have a good relationship between global trade volumes and so forth.
I'm going to have to hurry you. Favourite central banker?
Tallest anyway, Paul Volcker.
Tallest?
That's
Yeah.
not, you're not answering the question.
You're going by height.
I am going by height.
Okay.
No, that's
All right.
a real cop-out.
Height is
Okay. Most significant financial event in your career?
GFC, standing outside trying to get a signal on my mobile phone to try and move some money out of a UK high street bank because I was so convinced it was in danger that day.
Thanks very much, Jim.
Thank you very much. It's been great being a 3-time guest on your podcast.
Well,
It's
yeah,
been,
you're a market leader now. That was A Long Time in Finance with Jonathan Ford and Neil Collins. Production and editing by Nick Hilton, and our sponsorship partner is Briefcase.News. If you enjoyed the show, please rate and review it on your podcast app, as that will help new listeners find us.